How's it going? Welcome to the channel. My name is Nate. In this video, I'm going to show you how to trade flag patterns in real-world examples, not the cookie-cutter textbook method that other YouTubers show you. And the reason why I say that is because very rarely do you see perfect textbook examples of trade setups or entries. Therefore, you have to adapt to changing market conditions. And I'm going to show you guys how to do that. All right, let's get into it. Also, if you guys could like and subscribe, I would greatly appreciate it. I'm trying to grow this channel, and any support would be awesome. All right, so on to a real chart example. So we're looking at the chart of ON Semiconductors. We are on the daily time frame, but flag patterns work for any time frame. Okay, so number one, we have a strong move to the upside, followed by consolidation in a downward sloping channel. And then what do we have? A breakout and continuation to the upside. All right, so now that we know how to identify bull flag patterns, the next obvious question is, where do we enter a trade? Well, this is where things get tricky. Luckily for you guys, I've chosen several unique examples that go over various entry methods. But I have chosen the easiest to start with, don't worry. All right, so let's get into it. Now, the typical way that a YouTuber is going to teach you to enter a position on a bull flag breakout is they're going to say, when price breaks outside of the channel, enter a position. But that is very vague, it's not specific, and it doesn't work for all situations. So what I'm going to do is I'm going to show you various methods that you can use depending on market conditions. So I've started with the easiest example, and you can see here where price breaks out. This is very obviously our breakout candle, right? You have this big move to the upside, price breaks out of the channel, then retraces. So I want you to remember these words: enter on a retrace, enter on a retrace. Those are the key words. So price breaks out, and then what are we going to do? We're going to enter on a retrace. So price retraces and retest our bull flag right here. So this is option number one. You could enter a position here on a retrace of our breakout level. And if you had entered a position here, you would have benefited from this entire move to the upside if you had held on to the position, right? So that is option number one for entries. Well, what if you're very risk adverse and you're more of a conservative trader? Well, I'm going to show you an alternative method that you can use. So number one, we know that we can enter on a retrace of our breakout trend line. But another thing that you can do is wait for price to break out, retrace, and then essentially make a move to the upside, confirming the breakout. And then you could enter on a second retrace. So now that price broke out, we got to move to the upside, and then we got to pull back, and price retested our breakout level right here. So this could be the alternative entry method for a more conservative trader. Now, the reason why this is more of a conservative approach is because if this pattern was going to fail, it likely would have failed somewhere in this range. It probably wouldn't have broken above these highs right here. And so, if you take option number one on a retrace, which is perfectly fine, there's a potential for it to fail somewhere up in this range. It might not break above the breakout candle, retrace back into the channel, in which case the pattern has failed. So if you wait until a second retest, hey, price broke above these candles, I got to move up. So this is essentially a confirmed new trend to the upside. So that is why it's a safer option. You essentially have confirmed continuation to the upside. All right, so how do we measure the target level for flag patterns? This is one of my favorite things about trading flag patterns. I think this is really cool. Now, granted, price doesn't always trade up to these levels, but it acts as a good gauge. So what we're going to do is we are going to measure from the base of the move to the top of the flagpole. So it's roughly $27.90. Let me move this over a little bit. So then we're going to measure from the breakout level, which is right here. And we're going to measure exactly $27.90. I need to move the chart just a little bit. Up, there we go. So then what I'm going to do is take a trend line and extend it all the way across. So I know that, just pretend that none of this price action was here, right? And price had just broken out. And you're like, well, I wonder where price could potentially go. You can measure this out, and that's going to give you your target range right up there. And sure enough, what happened? Price traded all the way up into this level and then reversed. So now the next obvious question is going to be, well, where do we take profits? That's going to depend on you as a trader. Every trader is different. You know, some traders like to go for the big win. I myself am very risk adverse. I like to hit lots of singles and doubles, not home runs. So for me, if I had entered here on the first retrace, so let's say I entered here, basically where this green trend line is, I always take profits at levels, not at price ranges or percentages, but based off of levels. In this case, it would be a resistance level is what I would be looking for. And the first obvious resistance level is going to be the flagpole high right here. So if it was me who had entered this trade, I would have entered on the second pullback, so right here, and then I would have taken profits at this resistance level. You can see we have resistance from the essentially the high, the flagpole, and then we also have this resistance here. So this is where I would have taken profits. So you would have made a nice little, not a huge gain, but 11% gain, which is perfectly fine, right? And so the last question that we need to answer is, how do we know if the pattern failed? It's very easy. The way we know if a bull flag fails is if price trades back into this channel. And that's it. It's very simple. If price trades back into this channel, and not just like, see how we have this wick right here, that's perfectly fine. If you get a temporary dip below, that is no problem. But if you get several candles trading down into this channel, it is likely a failed breakout, in which case you would exit your position for a loss. It happens. It's part of trading. But the good thing about bull flags and bear flags is they are high probability trade setups. They tend to work out a majority of the time. All right, so we're on the daily chart of Disney with another bull flag example. So you can see we have a move up followed by bullish consolidation. And then what happens here? Well, we get a big old gap up above resistance, and you can see it retraces, retest this resistance, turns support, and then moves higher. So let's break down this chart. Another reason why I wanted to show you this setup was because we have this trend line here, which intersects with our bull flag. So this is actually kind of an indicator, and you can see if we zoom in here, you can see where our bull flag, where price started respecting this trend line right here. So when you combine this trend line with the bull flag, you know that you're likely going to get a breakout soon. And sure enough, that is exactly what happened. We got this big old breakout, so big in fact that price just gapped up right over this resistance level. And what happens when price breaks above a resistance level? Well, that resistance becomes support. So then you might be wondering, well, what the heck? You told us that we enter when price retraces to the breakout trend line, which never happens in this example. And you're right. But this goes back to what I was saying in the beginning, where you don't always get a perfect textbook example. And part of being a good trader is being able to adapt to different market conditions. And this is a perfect example of that. We have a bull flag setup that not everybody's going to be able to trade because they don't know that you can enter here. So yes, you can enter when price retraces to this resistance turn support, because this is now your support level. Whereas if price had broken out right here and then retraced, this trend line would be your support. But since price gapped above resistance and the resistance became support, this is now your support level. So when price trades up and then retraces into here, this is where you could enter a position. So knowing things like this is going to make you a better trader, because again, if you just go by the textbook example, you never would have entered this trade and you would have missed out on an amazing run that price had. In fact, it was so amazing that it gapped up again and continued to trade to the upside. But yeah, so you would have entered when price broke out and then retraced here. So the next obvious question to answer would be, where do we take profits? Well, on this chart, so let's say we have our bull flag pattern, right? And then price retraced, we entered on a breakout. So now we're in our position at this green level. I take profits based off of levels, not, a dollar amount or percentage, anything like that. And I'm going to look back here at past price information. And right here where this red trend line is, you can see we have this gap fill here. This is actually gap window because gap fill would be up here. But either way, this is going to act as major resistance. And you can see we have resistance going back all the way to here. pivot there, we have these pivot lows here, and then we have these pivot lows right here. So this is where I would take profits. And sure enough, if we zoom in, you can see bull flag, breakout, move higher, gap fill, and look at what happens. So price breaks above our resistance level and then trades back down and closes just below it. So that shows you how significant of a level this is. That price closed basically, you know, just on that level. So the fact that price temporarily broke above and then we got this huge reversal back below shows you how significant of a level that was. So that would be the proper place to take profits. All right, so here we are on the daily chart of IBM. I'm going to zoom out just a little bit, and you can see we have up here, we have a top made, price reverses, and then what happens over here? We get a move down followed by bearish consolidation, and then we get a breakdown in price below the bear flag. So you might be thinking, oh, thank God we got an easy one here. I know what I'm going to do. Do you? Take a look. Can you pinpoint an exact entry level? So we're trying to solve the problem of where would you enter a position when it's not obvious on this chart. So remember what I said, you're going to enter on a retrace to the breakdown level, but we don't see a retrace. So what do we do in this situation? Well, we're going to zoom in. So first, we're going to zoom into the hourly chart. So here we are on the hourly chart. And is it clear yet? No, not really. So what we're going to do is we're going to zoom in again to the 10-minute chart. All right, so here we are on the 10-minute chart. Zoomed out, you can see our bear flag pattern, which is the same one we were looking at on the 10-minute chart. I'm going to zoom in a little bit here. So here's our breakdown. So now that we're zoomed in, can you clearly see a defined retrace entry level? Yes. And I'm going to show you it is right here. So you can see where price broke down and then retraced, and then we got a nice big move to the downside. And in fact, we got another retrace where price tested these pivot lows, got rejected, and traded lower. So just like in the first example, there's a couple different ways that you can trade this. Number one, there's kind of the standard enter on a breakdown and a retrace to the breakout trend line, which would be this candle right here. So you could have entered here, entered your short position, and then taken profits lower. Or number two, the alternative way, which is the way that I would trade it, because it is a safer, more risk-adverse way. You know, remember the key to success in the markets is longevity, and the way that we ensure longevity is by being risk-adverse and trading smart. So I would have entered here. And you might be wondering why. Why not just enter right up here? Well, if you enter here, you're running the risk of, you don't exactly have confirmation yet. You're running the risk of the pattern failing and breaking back into the channel, and now you got to exit for a loss, right? But if you wait, so we had a breakdown, price retraced, and then what happens? It trades lower. So it breaks below these lows. You now have a level of resistance right here. And if you wait until price retraces into this level of resistance, that's like an extra level of resistance. It's almost like an additional confirming factor, essentially. It's just another way of ensuring that you're taking as little risk as possible. So, I mean, again, if this pattern was gonna fail, it likely would have, we might have seen something like this. And then it would have come down here and tried to make new lows, but failed, and then broken back up into the pattern. So we could have seen something like that. So this is why I would wait until these lows are broken and then enter on a retrace here. All right, on to the last example. We're on the chart of Dale, back on the daily time frame. So we have a big move up followed by bullish consolidation, which gives us our bull flag, and then we get a breakout. Now, the reason why I wanted to show you guys this example is because, I told you option number one is to enter on a retrace to the breakout trend line, but that doesn't actually happen here. We don't actually make it and retest right there. But what happens is we now have a support level that forms, and you can see it's right there. We have a support level. So what you can do is, number one, you could wait around for another retest of the channel, like an actual retest where, price pierces, or you can enter when price comes back down and retest the support level, because now that we've created a low here, this is going to be support. and you can see it kind of connects with this pivot right here, this pivot low here. So this is going to be support. So price breaks out. It doesn't quite retest here, so you wouldn't have entered yet, but now we have a support level that you can draw. And then what happens? Price trades down and retests that support level where it pierces really quick. You could have entered here. It pierces really quick, and then we get a massive move to the upside where price actually gaps up. So now that we've gone over all the examples, I want to finish with this. Number one, if you could like and subscribe, that would be amazing. But number two, very rarely are you ever going to get a perfect textbook trade setup. They don't happen very often, but there are various entry methods that you can use in an imperfect trading environment. So those are the things that you guys need to learn and study. And one of the ways that you can do that is by, actually going back and looking over charts. Go back and study, try and find examples of bull and bear flags and study them and see how price reacted, see what you could have done, see how the pattern failed, things like that. The stuff that I'm showing you guys can actually be used for different patterns as well, not just bull and bear flags. So I hope you guys enjoyed the video. Again, any support would be greatly appreciated. And thank you very much. Have a good one.